Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the economy in China, and specifically to look at the Chinese stock markets. Now, stock markets are generally speaking a very good indication as to what's happening in the economy of that country, providing the stock market itself predominantly hosts companies from that country. It gives us a really good benchmark as to whether or not those companies are growing in terms of their share price and therefore their value. And therefore, we've got a growing economy. And what we've seen in China over the past few years tells us that there are serious problems that are continuing to go on in China. In the last 4 years, the Chinese stock market has fallen every single year. And it's now at its lowest point since January 2019. So that means that any money that you'd put into the stock market back in 2019 would now be underwater. You'd actually be losing money. And this is very much a Chinese specific problem because the rest of the world has seen a major bull run on its stock markets over the same period. And over the last 3 years, the Chinese stock market has seen $6.5 trillion worth of value wiped out. So in today's video, we'll take a look at what's going on in the Chinese stock market and compare it to some of the other big indices from around the world to see how much you would have made or lost if you put $10,000 into all of those markets 1 year ago and 5 years ago. We'll have a look at what's been going on with regards to the Chinese authorities, because despite the fact that the stock market has been crashing, they've actually been trying to stimulate the market. They've introduced a variety of initiatives that were designed to try to boost the market back up, but unfortunately none of those initiatives have worked. And actually, if the Chinese authorities hadn't have done that, then the situation could actually be a lot worse than it is right now. And then finally today, I'll wrap up with my summary. So what I think is going on with the Chinese stock markets, what's dragging down the valuation of all of these companies, and what the outlook is for the next 6 to 12 months. But before we get started on all of that, I'd like to say thank you so much to everyone that's supporting the channel. Really, really mean this. If you're a long-term supporter, either through Patreon, where you can get early access to my videos and watch them advert-free, or YouTube membership or Buy Me a Coffee membership, thank you for that long-term support. Really does help to keep me motivated. And if you've bought me a coffee or sent me a YouTube super thanks recently, really, really appreciate the time and effort and the generosity involved in that. Thank you so much. This chart shows the movement in the CSI 300 index, which are the top 300 stocks traded on the Shanghai Stock Exchange and the Shenzhen Stock Exchange in China. And the reason I wanted to go back to 2009 is really just to show how badly the stock market has performed over the past 4 years. What this chart shows is that between May 2014 and February 2021, there was a sharp rise in the index, growing from a low point of 2,100 to more than 5,800 in February 2021. But unfortunately for China, over the last 3.5 years, we've seen the stock market index collapse to the current level of around 3,100, which means that over the past 3.5 years, the index has fallen by more than 45%. So if you'd invested $10,000 in February 2021 in a CSI 300 index tracker, it would now be worth around $5,450. Now, obviously, that's not a great investment, and it tells us that there are serious problems occurring in China right now. As I mentioned at the start of today's video, the Chinese authorities have actually been attempting to try to boost the market. And this chart shows the number of initiatives that the Chinese authorities have introduced since June 2023 in an effort to try to get the stock markets to start rising again. In August 2023, the authorities cut stamp duty and introduced a variety of other policies in an effort to try to attract in more investors and boost stock market prices. However, those initiatives had no impact on the market. And around a month later, the Chinese authorities introduced short selling restrictions. So basically what they were doing was trying to stop the hedge funds from shorting all of the shares in the Chinese stock market. Because when you get a situation where hedge funds are shorting shares in the market, it becomes very difficult for that share price to rise because the vast majority of trades are selling that stock, and that causes concern amongst other investors. They decide that the hedge funds obviously know something that they don't, and therefore they should get out before it falls further, and those circumstances can lead to a downward spiral in the price. Now, shortly after the introduction of the short selling restrictions, the Chinese authorities announced that they'd established a fund to buy shares themselves. So this was basically a way of China purchasing shares in the market. And you can see that that did have a short-term impact. Prices started to rise for a short period of time. However, the fundamentals in a market will always prevail. It's very difficult to be able to buy enough shares to change the market over the long term. And you can see that in the latter part of 2023 and the first couple of months of 2024, the markets fell again. There was actually a recovery in the market between February and May 2024. And that bounce back was partly due to the fact that the sentiment with regards to the Chinese economy was more buoyant. Everybody was expecting China to actually pick up in the second half of 2024. However, unfortunately, that enthusiasm has now diminished. People are now nervous that China is going to miss its 5% GDP target and that Chinese companies are starting to post losses. And as a result of that, we have seen a significant downward trend in terms of the prices, despite the fact that the authorities introduced more curbs on short sales and quants in July 2024. So really what this chart is showing us is that despite some major efforts by the Chinese authorities, the stock market index in China has fallen significantly over the past 18 months. And there is a major question here as to how far it would have fallen if China hadn't have introduced these initiatives, because these initiatives have been holding the market up, but despite that, the market is still going down. So let's have a look at how the CSI 300 performance compares to other markets around the world. This chart shows the movement in the CSI 300 index over the past 12 months. And what this shows is that 12 months ago, the index was sitting above 3,700. However, today it's down to around 3,150. So what that means is that if you'd invested $10,000 12 months ago, it would now be worth around $8,500, which represents a fall in value of 15%. This chart shows the movement in the Nikkei 225, which are the 225 largest companies listed in Japan, which is a very comparable market to China. And what this chart shows is that over the past 12 months, the index has increased from 33,500 to the current level of around 36,580. And that means that if you'd have invested $10,000 into this market a year ago, it would now be worth around $11,000, which is an increase of 10%. So that's a pretty good return in 1 year. This chart shows the movement in the Stocks Europe 600, which are 600 of the largest stocks in Europe. And over the past 12 months, this index has increased from around 462 to the current level of around 516. So if you'd have invested $10,000 this time last year, it would now be worth around $11,200, which represents an increase of 12%, which is very healthy. This chart shows the movement in the New York Stock Exchange over the last 12 months, which has increased from around 16,000 to the current level of above 19,100, which represents a year-on-year increase of around 20% and means that if you'd have invested $10,000 this time last year, it would now be worth around $12,000. This chart shows the movement in the S&P 500, which are 500 of the largest stocks in the USA. And what this shows is that this time last year, the index was sitting at around 4,450. Today, it's above 5,600 and means that if you'd have invested $10,000 a year ago, it would now be worth around 12,600, which represents an increase of around 26%. And the final index that I wanted to compare to is the Nasdaq index, which has a heavy focus on technology businesses. And what this shows is that this time last year, the index was sitting at around 13,700. Today, it's above 17,600, which represents an increase over the last 12 months of around 29% and means that if you'd have invested $10,000, it would be worth $12,900 today. This chart shows the movement of the CSI 300 index over the past 5 years. What this shows is really interesting because 5 years ago, the index was sitting at just under 4,000 at 3,972. However, today it's down to 3,150, which represents a fall of more than 20% over the past 5 years and means that if you'd have invested $10,000 5 years ago, it would now be worth around $7,950. And I think what's interesting about the shape of this chart is that between September 2019 and February 2021, there was a sharp rise in the index. However, over the last 3.5 years, we have seen a steady and consistent decline in the index. And the timing of the fall in the value of the index ties in with the problems that have been occurring in China, firstly with regards to all of the property development companies which started to unwind over the past 3 years, and then secondly we've seen a general slowdown in the Chinese economy over the course of the last 6 to 9 months. This chart shows the movement in the Nikkei 225 in Japan, and what this shows is that 5 years ago the index was sitting at just under 22,000. However, today it's above 36,500. which represents an increase over the past 5 years of more than 66%. So if you'd have invested $10,000, it would now be worth more than $16,000. And if you compare the shape of this chart, there was a drop in the valuation of the index at the start of 2020, when the world economy was hit by the COVID-19 pandemic. However, over the past 5 years, there has been a steady and consistent increase in the value of shares in Japan. This chart shows the movement in the Stock Europe 600 over the past 5 years, and it shows that 5 years ago the index was sitting at around 450. Today it's at 515, which represents growth of more than 32% and means that your $10,000 investment would today be worth more than $13,000. And again here you can see that we've had steady, consistent growth over the past 5 years in this index. The New York Stock Exchange has also seen steady growth over the past 5 years, excluding the drop-off as a result of the COVID-19 pandemic, which hit every index across the world. And over the past 5 years, the index is up by more than 45%, and means that your $10,000 investment would be worth around $14,500 today. The S&P 500 chart has a similar growth profile. However, the actual growth has been significantly greater, growing by 87% in the past 5 years, which means that a $10,000 investment would be worth today more than $18,700. And not surprisingly, the best performing index over the past 5 years has been the Nasdaq, which is up by more than 116% and means that a $10,000 investment 5 years ago would today be worth more than $21,600. This chart compares the movement in the CSI 300 against some of the other major indices around the world over the past 3.5 years, and the scale on the right hand side of this chart goes from positive 60% growth at the top to negative 50% growth at the bottom. Now the CSI 300, the Chinese stock market, is shown by the black line which is at the bottom of this chart. And what this shows is that over the past 3.5 years the index has been falling consistently and is down by more than 40% over the last 3.5 years. Now the other indices that are compared on this chart are the Tokyo Stock Exchange, which is shown by the green line, which is the next closest to the Chinese Stock Exchange, the Stocks Europe 600 price, which is shown by the darker grey line just above the green line on the right hand side here, the MSCI World Index, which compares all stock market prices around the world, which is shown by the light red line, the S&P 500 index, which is shown by the blue line, and the NSE Nifty 50 index, which is shown by the red line at the top. Now, if we start off by looking at what happened in 2021, you can see that the Chinese index moved into negative territory. It was falling in value. However, all of the other indexes were actually growing in that year. Now, in 2022, following Russia's invasion of Ukraine, there was a lot of uncertainty around the world. Commodity prices spiked. We saw an increase in oil and gas and other commodity prices, all of which put pressure on the global economy, and there was a lot of uncertainty as to what was going to happen. And in times of uncertainty, a lot of investors decide to pull out of the stock market and put their money into safer asset classes. So we did see some prices coming down in stock markets around the world, and that's reflected by the movement in 2022. You can see that China at the bottom had the biggest negative impact, and that's quite interesting because China wasn't actually involved in anything to do with the war. It wasn't introducing sanctions against Russia, and it wasn't trying to do anything from a military perspective. but because it's one of the biggest buyers of commodities in the world, it was suffering as a result of the fact that all those commodity prices were going up. But you can see that generally speaking, in 2022, there was a softening in the markets. The indices started to come down. They didn't come down as badly as China, but a lot of the indexes did actually move into negative territory during 2022 and started to recover at the end of it. Now, in 2023, there was more of a stabilization in the global economy. The impact of the war in Ukraine started to lessen in terms of oil prices and all of the other commodities. But despite that, the Chinese stock market continued to fall. And if you look at what happened with the other indexes, between the start and the end of 2023, all of the indexes actually rose in value. Now, interestingly, the stock market in Tokyo was still in negative territory at that point. However, it was moving towards positive growth. And if we look at what's happened in 2024, you can see that the Chinese market has continued to fall. There was that bounce back at the start of the year when a lot of people were hoping that China was going to recover. However, that enthusiasm has now faded and the markets are falling again. And you can see that the gap between the Chinese market and the rest of the world has widened significantly in 2024. All of the other markets are now back in positive growth territory, and some of them are in significant growth. However, China is in significant decline, more than 40%. And this tells us that the problems in China are specific to the Chinese economy. This isn't a global phenomenon. It's down to what's happening in China itself. So what's the summary and conclusion today? Well, I wanted to post this video because, as I said right at the start, the valuation of the stock markets in a country gives you a really good indication as to what's happening in that economy. If that economy is doing well, and so all of the companies within that economy are growing, they're increasing their revenue and their profits, that means that their share prices should also be growing, their total market cap will also be going up, and you'll see an increase in the index for that country. However, if you have the opposite situation, if you have an economy that's struggling, companies are struggling to increase either their revenue or their profits or both, then you'll see a fall in the share price, and you'll also see overseas investors deciding that they no longer want to invest into that economy. They will move their money into other places. And so we'll see a fall in the valuation of the companies, fall in share prices, and a fall in the index. And what we've seen from today's data is that in every single one of the past 4 years, the Chinese stock market has fallen in value. So any money that you'd have put into the markets 4 years ago would now be worth less. And obviously, that's not a great situation because the old adage is that you keep putting money into the markets and over the long term, the markets will go up and you'll make a profit. So the last thing that you want as an investor is to put money into a market that's going down every single year. But that's what's been happening in China. But it hasn't been happening in the rest of the world. As we saw from the data earlier, every other market has been going up. If you'd have put $10,000 in, you'd be sitting on a healthy profit. And in fact, some of the markets have gone up significantly. So you're sitting on a massive profit. So that tells us that China isn't moving along with the rest of the world. This isn't a global phenomenon. This is specific to what's going on in China itself. And as I've talked about over the past few years, there have been some major problems in China. The first problems that came to light were with the property sector. In the previous 20 years, there was an economic boom that was driven by the property sector. The laws were changed in China, allowing people to actually buy their own property, and there was a feeding frenzy. Lots of people wanted to buy apartments, and in fact, lots of Chinese individuals wanted to buy multiple apartments as investments. And as a result of that, we saw the growth of these huge property development companies. They were building whole cities all across China. In many situations, they were building tens of thousands of apartments and actually pre-selling them. They were taking the money from Chinese individuals in advance of laying any bricks whatsoever. And unfortunately, as that frenzy started to get bigger and bigger, people were actually taking mortgages in advance of those apartments being built, giving the money to the developers. The developers were then using that money to start a new development, taking a whole lot more cash, and for a while everything was going really well. However, the Chinese authorities decided that they needed to pull the reins in. They introduced a policy called the 3 red lines, where there were basically tests for all of the property development companies, Many of those companies failed those tests immediately, and that meant that they no longer had access to the huge amounts of bank debt that they were using to roll out all of their new apartment buildings. And as a result of that, the cash flow dried up. They weren't able to complete those apartments, and many people in China are now left with mortgages without actually having an apartment at all, which is absolutely outrageous. So we saw a major collapse in the property sector, which started around 3 years ago. And the biggest example was Evergrande, which I've talked about a lot on the channel. That company is now in liquidation, and the investors are likely to lose all of their money. And unfortunately for a lot of the people in China, they're not going to get their apartments. So we've seen a collapse in the property sector. But we've also seen major problems occurring right across the Chinese economy. Over the past few years, China's target growth of GDP has been set at 5%. And in 2023, it achieved that figure. However, in 2024, we are seeing a significant slowdown, and there's now a major question mark as to whether or not China will hit 5% this year. But aside from the GDP growth, there are some serious problems. We've got deflation, which keeps coming back to the Chinese economy. And what that means is that year on year, prices are falling on the shelves in China, which sounds great from a consumer's point of view, but is an absolute disaster for Chinese companies because they are selling their products today for less than they were this time 12 months ago. And as their costs have been rising, that means that a lot of companies in China are now struggling to make any sort of profit, and many are estimated to be loss-making. And producer prices, also known as factory gate prices, have been falling in double-digit territory for more than 12 months. So this represents an absolute nightmare if you're a Chinese company. And all of these factors are now feeding through into the company results in China. So we're seeing companies reporting lower profits or losses. That means that their share prices are falling and the index is starting to tumble. And what this tells us is that overseas investors no longer feel comfortable investing into China. They've been taking their money out of the market. And as a result of that, the index is down. And it's forecast that over the next 6 to 12 months, unless the Chinese authorities can do something to repair the economy, the index will continue falling, and that isn't happening everywhere else. We are seeing wobbles in the stock market in the US and Europe. However, we're seeing things bouncing back relatively quickly. So China is an anomaly right now, and it's all because of what's happening with the fundamental issues in the Chinese economy. So the overall summary of today's video is that over the last 4 or 5 years, we have seen the Chinese stock markets tumbling. That's as a result of the problems that have been building in China. Those problems are getting worse. The economy is slowing down. It's likely that the stock market index will continue falling, and it's going to be a major problem for the Chinese authorities because they're trying to support the markets at the same time as they're trying to repair the economy, and there simply isn't enough cash to be able to do all of this. So there is a major question mark over what's going to happen in China over the course of the next 6 to 12 months. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.